Good evening, everyone. Hope you all are doing well. So, today we are going to discuss lecture number 12 of SBR, which is IAS-24 Related Party and Disclosure. This standard is very important for SBR as well as Audit and Assurance student. Why this standard has a significant impact? First thing is any related party transaction is material. It could be material by qualitative as well as quantitative. Qualitative means by the nature, or by quantitative means by the amount. So whenever there is a related party transaction, it is material, even the amount is zero or it is significant. The first thing is about the materiality. Now the scope of IAS 24 related party. IAS 24 requires disclosure of related party transaction and outstanding balances in the separate financial statements of parent, venture, or an investor. Why IAS 24 require disclosure of this transaction? As I have just mentioned that it is a very significant transaction, even material by qualitative as well as quantitative. We will read why disclosure is important in the later slide. First, read the objective. The objective is to ensure that financial statements contain necessary disclosures to draw attention to the possibility that the financial position and performance may have been affected by the existence of related parties, transactions, and balances with them. For the truth and fair representation of the financial statement, financial position, and performance, related party transactions should be disclosed. Now, the definition of a related party. A related party is a person or an entity that is related to the reporting entity. It includes a person, related entity. Related person means a person with control. Control comes more than 50%. Sometimes control comes with less than 50%. We will cover this thing in the consolidation topic. Joint control. Joint control is the next topic, which is IFRS 11. Joint control means joint venture or joint operation, means when two entities work together. Or significant influence. Significant influence means more than 20% over the entity. A close family member of such a person, it could be your brother, sister, father, mother, anyone. Related entity. Entities under common control. Joint ventures. Common control means subsidiary or sub-subsidiary. Joint ventures, associates, or entities with significant influence, means more than 20%. Post-employment benefit plans for employees of the entity or a related party. Key management personnel, KMP, of the entity or its parents. What are KMPs? Management chief executive directors, such as. Close family members include your spouse, children, dependents, or any person expected to be influenced by the individual. Now, key terms: control, power over the investee, usually more than 50% voting rights. Joint control, contractually agreed sharing of control. Significant influence, power to participate in financial and operating policy decisions, usually equal to or greater than 20% holding. Key management personnel, individuals having authority and responsibility for planning, directing, and controlling activities of the entity. And who are those individuals? Such as management, TCWGs, executive, non-executive director. Required disclosures. Entities must disclose the following regarding related party transactions, relationships, and balances. A relationship, even if no transaction occur. If there is a related party relationship, even though there is no transaction between these related parties, still disclosure is required. Parent subsidiary relationship, entities ultimate controlling party. If transactions occurred, means if there is a transaction, disclose nature of the relationship, description of transaction, amount of transaction, even though material or by nature or by qualitative, whatever. Outstanding balances, if any, including commitments. In most of the cases, the organization or the entities obtain loan from the related parties. Provision for doubtful debt, bad debt written off. Example of transactions: purchases, sale of goods or services, leases, transfers, guarantees, loans, KMP compensation, key management, personal compensations, benefit, it could be anything, etc. 4. Disclosure of key management personal KMP compensation. Now, must disclose in total even if within related parties transactions are done on market basis. Means transactions are on arm's length basis and broken into categories such as short-term employee benefit, post-employment benefit, other long-term benefits, termination benefit, share-based payment. These employee benefit is the IAS-19, which we'll cover in the later lecture, and IFRS 2 share-based payment is a separate topic which we will cover in 2 to 3 days. Now, exemption from disclosure: when you don't need to disclose. Intra-group transaction means subsidiary parent transaction are exempt from disclosure in consolidated financial statement. The important word is in consolidated financial statement. Why there is no need to? Because the transaction is between the group members. So there is no need to disclose. Disclosures are not required for government related entities when both entities are controlled by the same government and there is no significant influence or control. There is an exemptive: understand substance over form, even if there's no legal ownership, control, or influence can make a party related. Focus on judgment areas, example, determining significant influence, disclosing KMP compensation, or related party relationship not evident from shareholding. Be ready to evaluate disclosures in a scenario and comment on adequacy or omission. Now, an information is material if it changes the decision of its user. Quantitative aspect of materiality, qualitative aspect of materiality. There is a note. In case of government, its subsidiaries and fellow subsidiaries, there is an exemption from routine disclosure. You just need to disclose significant transaction during the year and relationship between related parties. Note, in IAS-24 related party transactions, sometimes a transaction may be immaterial by its quantitative aspect, means amount, but may be material by its qualitative aspect. Example, materiality level of a company 10,000, but director sold a company car for 1,000. If you are comparing this 1,000 with the materiality, of course it is immaterial by quantitative, but to his brother is still material from qualitative aspect, even below materiality from the quantitative aspect. So it means related party transactions are always material, even if the amount of transaction is 0 or 1 million. Why disclosure is necessary? Okay, let's read the why disclosure is necessary. Transparency and fair presentation. Related party transactions may not be conducted at arm's length market basis, may not reflect market trends. Disclosure helps users assess whether the financial statements present a true and fair view, especially if financial results are influenced by special arrangements. 2. Risk of manipulation or bias. Management may use related party transaction to shift profits. Of course, this is one of the major, or you can say the important shift, to shift profits, hide liabilities, or manipulate earnings. Disclosure reduces the risk of fraud and misstatement by making such transaction visible to stakeholders. Even this amount or this risk is more significant, as even though you are going to send a confirmation to related parties, they are also with the management, so they can manipulate this thing as well. So now you can understand how important this standard is. Enhances user understanding. In your professional career, like in SBR or AAA, you will not get this concept into much detail. But whenever you step into the real world, into the practical world, you will be much more familiar with these type of transactions. Even though there are billion or trillion dollar transactions of related parties. Enhances user understanding. Investors, regulators, and analysts need to know how much of an entity's performance depends on transactions with related parties, which may not continue under normal market conditions. For example, revenue from a parent company may not be as reliable as revenue from independent customers. Help assess independence. Knowing if a key decision makers, KMP, or their families are involved in transactions can help assess if management actions are in best interest of shareholders or conflicted. Legal and regulatory compliance. Many jurisdictions and regulators require disclosure of related party transaction. Non-disclosure may lead to non-compliance with IFRS and legal consequences, example, audit qualification and penalties. If there is no related party transaction disclosure, then of course auditor will express a qualified opinion. Assist in comparability. Disclosure helps users compare financial statements across companies by identifying non-arm's length transactions that affect profitability, cash flows, or financial position. In SBR exam terms, IAS-24 helps uphold the qualitative characteristics of financial information from the conceptual framework, especially faithful representation, relevance, and understandability. These are the first topics which every accountant covered while covering the accounting terminologies. This comes under IAS 1. Okay. Disclosing related party ensures that users, means stakeholders of financial statements, are aware of transactions that may not reflect normal market conditions, means not on arm's length, enhancing transparency, trust, and fair presentation. The overall conclusion is we should have to disclose everything for the better and true presentation for the users. SBR practice scenario. IAS-24 related party disclosure scenario. You are a financial reporting manager at Key Cloud Limited, a tech company listed on a stock. Oh, it is listed. During your year and review, you noted the following. The company has received a large software development contract worth 40 million from Innova Tech Private Limited, a company owned by CEO's brother. What do you think? This is a related party, even though this is KMP, so of course it is a related party. No formal tender process was followed, means no arm plan, no market basis. The contract was directly awarded, no check and balance, no terms and conditions. Wow. The revenue from this contract is 20% of total revenue for the year. The transaction was not disclosed in the draft financial statement. The CEO argues that my brother is not a shareholder or board member. He has nothing to do with our financial. Oh my God, he has to do with your financial, as the 20% of total revenue come from this contract. What are you talking about, CEO? We shouldn't need to disclose this. Pathetic. Vague reply by the CEO. Vague argument. Required. Evaluate whether disclosure is required under IAS-24 and explain why such disclosure is important to users of the financial statements. Suggested answer. Identification of related party. Under IAS-24, a close family member of a key personnel management is considered a related party. In this case, the CEO is clearly a KMP of T Cloud Limited, therefore his brother is a related party. Nature of transaction. Significant contract. 40 million is a significant, even though it's zero, still related party transactions are significant. A significant contract was awarded to a related party, 40 million, 20% of revenue. No competitive process was followed, raising questions on whether the transaction was at arm's length. Disclosure requirement. IAS-24 requires disclosure of the nature of the relationship, description and amount of the transaction, whether the terms were at arm's length, any outstanding balances or commitments. This transaction clearly falls within the scope of disclosure. So means there is need of disclosure. Why disclosure is important? Linked to user needs. Faithful representation. Users need to understand that a major portion of revenue came from a non-independent source. Transparency. Lack of disclosure may imply the entity is hiding potential conflict of interest. Risk assessment. Investors may reassess the sustainability of revenue if a large portion is dependent on related parties. Governance concerns. Direct awarding without a tender may raise ethical or control weakness. Impact of non-disclosure could lead to qualified audit opinion, of course, penalties, potential regulatory non-compliance results in high level of fines and penalties, damages investor confidence and market integrity, which may affect the business as reputation goes down, investor withdraw their investment. Conclusion. Disclosure is clearly required under IAS 24 and it is crucial to ensure transparency, accountability, and informed decision making for stakeholders. So that's it for IAS 24 related party and disclosure. If you have any queries or any doubt, feel free to ask. I will try my best to upload the remaining IAS and IFRS lectures before announcing your result. Then we will move forward to the consolidation, which will be the last topic of SBR and F7 student. After that, I will try to solve full-fledged past paper questions and then will record a video on that and will upload on your YouTube channel. So stay aggressive and do your best. Take care. Good luck.